In this week's episode of the Stockscores Market Minutes, we'll talk about the stock market crash that we have underway, whether it's going to continue, and what the game plan should be for you to trade it. Stock market crashes create opportunity. I'll show you how to take advantage of them. All right, so another bit of a losing week for the market. We've had lots of volatility, and that has many investors nervous. But of course, this has been coming for a while. We've seen it with the shape of the chart patterns that we've talked about here every week. What I want to talk about this week is a little game plan for how to take advantage of these, because market crashes, corrections, whatever you want to call them, they create opportunity. Eventually, the catalyst for a reversal is simply that prices have gone down too much. There is value in the market when prices pull back a lot, and of course we're seeing that. The small cap sector has been under pressure for a long time, and now the large cap, the big name tech stocks, well, they're playing catch up with the rest of the market. Well, eventually prices get so low, people want to buy again because there's value there, and that sets up for the next rally. So before I explain how to take advantage of it, I want to draw you a little picture. This is basically how market cycles work, and you see this over and over and over again. Whether you are a day trader, a swing trader, a position trader, a long-term investor, if you can understand how to read chart patterns, and it's really not that hard, you can really do well. And so I want to map out the typical cycle for a market, for a stock, for a commodity, for a cryptocurrency, whatever. All right, so let's just jump into a little black screen here, and I'm going to draw some lines. So typically a stock will be kind of going sideways, and then it starts to go up. When it goes up too fast, people want to take profits, and so you get a pullback. And then, because the fundamentals may be getting better, people like the stock, like the industry, what have you, it starts to go up again. Gets a little extended, and it pulls back again. And it just follows that cycle of moving up, getting a little overextended, pulling back on profit taking, and then resuming the upward trend line. Now, the upward trend is typically broken when there's a falling top that breaks the upward trend line. So if I'm going to draw sort of an upward trend line which cuts across the lows or comes close to them, and then when you break that upward trend line, you ultimately then move lower. Now, the S&P did that a few months ago, and of course now we've seen the follow through from that. So how do markets behave on the downside? It's very similar. They move down, they go down a little too fast, they pull up. They move down, they pull up, they move down, pull up. And typically at the end of the trend, you get a parabolic move away from the trend line. So if we were to draw this trend line, when you're far below the trend line in a parabolic move, you start to base out, and value is there for investors to want to snap up bargains, and you get a reversal. And that reversal typically starts with a build of a rising bottom and then a break of the downward trend line from a rising bottom. So that's really simplified, but that's how markets tend to behave. And so as we go through the charts this week, we're going to try to document this, and I'm going to give you some sense of what to do. But before we do that, let's just talk about general strategy. All right, and in an upward trend, you want to buy the pullbacks. You do not want to chase the market when it's running away from the trend line. That's a no-go. All right, so you want to buy when there's a pullback and then a break of a pullback. So here or here, that's the ideal time to buy. And it doesn't matter if you're a day trader trading off of a 2-minute chart, or if you're a long-term investor trading off of a weekly chart, the principle is the same. Now, when you're moving in a downward trend in the market, you generally want to be short selling, and so you want to short the market when the market rallies up to the trend line. Or if you're a short-term trader, you can trade bounces by buying when the market gets overextended with the expectation that it's going to go up. Now, that's a very short-term trade. It's not going to last very long because the dominant trend is down. When you get parabolic and away from that downward trend line, well, then you've got that much more room to move up. But don't expect to be a long-term holder on the buy side as long as the longer term trend of the overall market is down. Now, the only exception to that is when you have a sector of the market that is moving opposite the market. So for example, right now, the energy sector is moving up despite the overall market moving down. So the energy sector, you would trade using these principles where you're going to buy pullbacks and breaks of pullbacks. Okay, all right, now with that in mind, let's look at some charts. Here's the S&P 500 chart, and you can see it moved up, it would pull back. Let's do that in a different color. It would move up, it would pull back, it would move up, it would have a little pullback, and you see that. In the weekly charts, the pullbacks don't show up so much. If we were to look at this on a daily chart, it becomes a lot more obvious. But you can see that there's these little pullbacks, and that defines the upward trend line. Well, the upward trend line was broken. That's step one in a reversal. Okay, and then we built a falling top. That was step two. And then we're breaking down from a falling top. That is step three. It's likely that the market will move lower from here. However, if we go back to one of those principles I talked about earlier, when the market gets extended and away from the trend line, it usually bounces back. So let's go back to the chart and realize that our downward trend line now on the S&P is right there like that. And you can see that when it runs away into the downside, you get a little bounce back. That was a 3-week bounce. And we're kind of doing that again. So it wouldn't surprise me if we get a little comeback rally. Now these are called bull traps. They're called bull traps because the buyers come in, maybe there's a week of strength and buyers say, oh good, the market is back in favor, the buyers are back in control. But until that downward trend line is broken, the buyers are not in control. It's the sellers that are in control, and you don't want to fight against the sector of the market or the group in the market that is in control. Okay, so right now the sellers are in control of the market, a little bit too emotional, push stocks down too much, and so it would not surprise me if we get a week or two of an upward move sometime in the next 3 or 4 weeks. Could be next week, it could be in a couple weeks, we'll see. But ultimately we need to break that downward trend line before we can get optimistic. So on the S&P 500 right now, long term, I am bearish, but we can look at the short term chart, the intraday, say 1 month, 60-minute chart, and you can see that there is the potential here to break that downward trend line. Let me draw that in red so it looks bad. And you can see we're making a little double bottom, and if we can bounce up through that, we may get that 1 or 2 weeks of strength. So in the short term, I'm still negative, I'm still bearish, but there is the potential for a little bit of a bounce back because the market bounced off of a little bit of very short-term support on Friday. All right, now let's take a look at the Nasdaq. It's going to look pretty similar, but because the Nasdaq contains a lot of those hot tech stocks, you can see that it's actually fared worse. It is lower than the S&P. It plowed through support in the last couple of weeks. It's still in a downward trend. We have run away from the downward trend, and so you could argue we're a little bit oversold, maybe due for a bounce back, but I don't see any sign of one yet, so remain bearish on Nasdaq. All right, let's take a look at the small cap stocks. Their chart is a little bit different. It is also negative, but it's not been giving up as much because it's already underperformed the S&P and the Nasdaq. So the small caps have been out of favor for a long time. And although this chart doesn't look that bad, if you go look at a bunch of biotech stocks or small cap stocks in general, you will see most of them have been in long-term downward trends for months. And so they're ready to turn. I think they will turn first, but there's still no sign of a real turn yet. So we don't want to get too optimistic, but I think that's where the opportunities will start when the market can stabilize. All right, let's switch over to the Canadian market now. T.XIU is the Canadian sector. You see here, it looks a lot better than the S&P, and that's because the Canadian market has a lot of energy stocks, and we'll see in a moment the energy sector strong. So I'm going to give this a neutral rating. It has been an upward trend for some time, but over the last few months, it's been sideways. It's kind of a two-market market. You've got commodities and all of the commodity stocks, which are holding up well, and then you've got the rest of the market, which generally is suffering like US stocks are. All right, let's take a look at the junior market in Canada. Symbol for that is $JX. And you can see that it is out of favor. It's breaking down through support, more likely to go lower than higher, so I'm bearish on the TSX Venture. All right, let's jump over to the US dollar, which is an important one because it is an example of a chart that has gone parabolic. So if I draw an upward trend line there, you can see that it's linear and we are way above this. So remember, one of those principles that I talked about at the top of the video is when trends go parabolic away from their upward trend line, they're likely to pull back in the short term. And it makes even more sense because the US dollar is coming into the highs that it hit during the early phase of the COVID crash. And so I think although there's no sign of weakness in the US dollar, it's due for weakness. And I suspect that we will get a pullback in the US dollar in the next couple of weeks, could be next week. And if we do, that will be somewhat supportive for stocks because the reason the US dollar has gone parabolic to the upside is because of rising interest rates. So let's take a look at the chart of the US Treasury bond market. Now this is an inverse ETF on US Treasuries. So inverse meaning it goes up when the bond market goes down. And that's very helpful to use this chart because interest rates go up when the bond market goes down. So if we're looking at this chart, really, we're looking at a good proxy for interest rates. Well, you can see that interest rates are going parabolically higher. We are far above the trend line, and we know that that means we should get a pullback soon. So US dollar coming into resistance and parabolic, the interest rate chart, bond market chart, parabolic, and therefore we are due for a little bit of a rationalization of the interest rate market. That could happen as early as next week, but we'll wait for a breakdown. Now, how do you know that the breakdown is coming? Well, instead of looking at the 3-year weekly chart, which is what I've been doing so far, try just looking at the intraday chart. On TBT, for example, go to a 1-month chart. You can do this on Stockscores, it's free. Go to the 60-minute chart and just watch for a break of this upward trend line. If we start to break that from a falling top, we will have done that cycle that I talked about at the top of the video. You can see it goes up, it pulls back, it goes up, it pulls back, it goes up, it pulls back. Now we've run away parabolically, we need to come down and maybe break that, and that would set up for a pullback in the short term for interest rates. That doesn't mean a long-term reversal of interest rates, but it means in the short term interest rates are due for a pullback. That'll drag the US dollar down. That'll maybe help things like gold, which are priced in US dollars, but it'll also give some support to the stock market. All right, we want to take a look at the oil and gold charts now, which are heavily linked to the US dollar. And despite the US dollar going up, gold has managed to stay strong. You know, if it had not been for a very strong US dollar, gold would probably be even higher, but it's actually starting to break out again. It's been in this sideways range for about 3 months, but you can see it's tickling out of the top of that range. I think it's more likely to go higher than lower, coming into this range here from, I don't know, 2019. And it's quite reasonable to expect the energy market to continue to be strong. And so what I want you to do here, an opportunity, part of the game plan, is to focus on that energy sector and buy pullbacks in energy stocks. Pullbacks to the trend line, and then when they start to break the trend line, start to break the pullback, bouncing off of the trend line, that's the opportunity. So if I was to draw it, you've got an upward trend and you had a pullback, and when you start to break that pullback, as long as that upward trend line hasn't been broken on whatever energy stock you're interested in, you can take advantage of the overall sector likely moving higher. All right, let's take a look at gold. And of course, as I said, gold has been dragged down quite considerably by the strength in the US dollar over the last 2 or 3 weeks. But in the big picture, it's still a decent chart. You still have optimism. You're coming into some resistance, which is what stalled it a while ago. Had a little pullback here, but I think there may be an opportunity to trade a bounce in the precious metal stocks. So what do you want to watch for? What's that pattern? You've been going down in gold stocks. If you can break the downward trend line on perhaps the daily chart or even the hourly chart on some of your favorite gold stocks, that may be the sign of a bounce. Appropriate for a swing trader, not really for a long-term investor. If you're a swing trader, you can take advantage of this market, the gold stock market, being oversold, due for a bounce. If you start to get some weakness in the US dollar, you may see that gold sector start to move up a little bit again. All right, let's take a final look at some of the cryptocurrencies. I know many of you like to follow those. GBTC is testing support. It's got pessimism, and I'm worried that we could get a breakdown. Now we are at support, and so it would be reasonable to maybe get a little bit of a bounce. But if we break down through this sideways trend line, then the next level is down there. That's your next level of support. And so generally I'm very bearish on the crypto market until it can break this cycle of falling tops. That cycle of falling tops means pessimism. And right now, that's what this market is gripped by, is pessimism. The sellers are in control. Well, I hope you've enjoyed this analysis. I'll have another video out later in the week. I know some of you are looking for some of the day trading stuff that I normally do. I'll launch a video of that very soon in the next few days. But I hope that you've enjoyed this one. If you did, click on the like button. It helps the channel. Subscribe, and most importantly, trade well.